Good evening, everyone, and welcome to Let's Talk Sustainable Investing 101. My name is Garner. I'm a member of the Nith Valley Eco Boosters and your host for tonight's event, which is an introduction to sustainable investing, what it is, its positive and negative effects, and how one might start investing in this way. First, a couple disclaimers. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations to any individual or for any specific security. It is only intended to provide education about the financial industry. Any past performance discussed during this program is no guarantee of future results. Investing involves risk, including the possible loss of principal capital. Okay, now that's enough out of me. On to the show. Our speaker for the evening is Tim Nash. Tim is the founder and president of Good Investing, a fee-only financial planning firm that teaches ordinary people how to invest their own money online in sustainable investment funds. As an expert on socially responsible investing, impact investing, and the green economy, he is regularly featured in publications such as Money Sense, Reuters, and Advisor's Edge. He has a BA in economics, a master's in strategic leadership towards sustainability, and hosts a weekly podcast called Responsible Investing for a Sustainable Economy. You can find that at the Toronto Star website or wherever you get your podcasts. Tim, welcome and take it away.
Oh my goodness, thank you so much for having me. I take it from your smile, you can hear me okay? Everything's good to go there. Fantastic. Welcome everyone. Thank you so much for choosing to spend your Wednesday evening with me. I think it's just so great, this sort of Eco Boosters Club that, I think you get together and have some great conversations, and I'm just honored to be with you tonight. So I'm gonna go ahead and share my screen. Here we go. You should be able to see my Sustainable Investing 101 slide there.
Yep, we can see it.
Perfect. So before I jump into the slides, I'll just kind of introduce myself. I'll give you kind of the quick background on me. So I grew up in London, Ontario, not too far away, with my dad in the investment industry. So I sort of grew up around stocks and bonds. For my undergrad, I studied economics and philosophy. And so I was kind of a weirdo in each of those faculties. And in my economics courses, I was sort of always asking some tough questions. And it became really clear to me that the economic models I was learning were not addressing so many of the social and environmental issues that were really important to me. So I started asking some tough questions, and my professors didn't really have good answers for me. So after getting my BA in economics, I went to Sweden and I did my master's in strategic leadership towards sustainability, a wonderful group put on there by an organization called The Natural Step. If anyone's familiar with them, they're pretty active here in Canada, but also around the world. And did my thesis focused on this topic of sustainable investing. I came back to Canada in July of 2008, ready to take the investment world by storm. And well, if anyone knows what happened in the fall, in October of 2008, well, we had a huge financial crash. So really sustainability got thrown on the back burner. Nobody really was talking about sustainable investing for quite a while. So I started my first business out of that crash, really, had to go at it, but had to find other ways of making money. So I taught economics at Sheridan College for a number of years, and then really just kind of kept at it. I created my blog, sustainableeconomist.com, and just started writing about these things. And people just kept reaching out saying, Tim, how the heck do I actually do this? So I went back to school. I got my CFP designation. I'm a certified financial planner. And in 2018, I founded Good Investing, which is really designed to be able to help regular, everyday people kind of figure out their finances and ultimately, move their money and invest in a way that does align with their values. So it's been quite a journey that I've been on. It's been an incredible last few years with the interest in sustainable investing. And really what I'm hoping to do tonight is to sort of give you an overview, kind of some of the language and how to think about these things. I'm going to try to avoid going too deep into the weeds in this presentation, knowing that there is a Q&A at the end. So, certainly if there are questions, or if there's an issue or a term that I touch on and you're like, I'd really love to learn more about that, then, just make a note, throw it in the Q&A, we can get a conversation going in the chat, and that really, know that I'm here for you, and able to facilitate whatever kind of learning you want to do tonight. But I do have a little presentation prepared, so let's jump into it. I thank you, Garner, so much for that land acknowledgement. Very, very important. And, there are a couple of acknowledgements that I like to make before I start my presentation on sustainable investing. Number one is that simply investing comes with privilege. The fact that we're able to talk about investing means that we have enough, right? That every month you've got your revenues, you've got your expenses. If you've got a little bit more income, more money coming in than you're spending, you've got money left over at the end of the month. And we're able to put that to work for the long term. There's a lot of privilege in simply having a surplus at the end of the month. So many people are living paycheck to paycheck right now. So really want to acknowledge the privilege of just having enough money that we can put it into the markets. From there, sustainable investing is not a panacea. This is not a silver bullet. This is not going to change the world on its own. That, I'm a firm believer in diversity of tactics. So we need to be pulling on lots of different levers to be able to create a more sustainable future. That includes, getting involved in government and politics, and, voting for candidates and volunteering. It's, nonprofit sectors, being involved in community groups such that you are all a part of. That there are a lot of things that we can be doing. This is just one little piece of the impact. That this isn't going to change the world on its own. But my belief is that the investment industry has so much power right now in our economy that, really, if you're doing all these other things and you're not looking at your investments, you're missing a big part of the picture. So really, I do want to show this sort of big picture that, when it comes to investing, this is not the whole economy. This is an image that I love. When it comes to investing, you're going to see a lot of pie charts. I've got a couple in my presentation. Well, I figured I would start you off with a cake chart. So this is an image from a mentor of mine. Her name is Hazel Henderson. You can see she came up with this 1982. That's coincidentally the year I was born. So, she did pass away last year, but she's been such a mentor to me, and just, really a lot of her thinking is just so foundational. With this cake chart, this really is looking at the broad economy, right? That when it comes to the economy, it's kind of like a cake, that we do have Mother Nature, right? That without a planet, without healthy ecosystems, there is no society, there is no economy. That really everything, our entire economy rests upon this, dark chocolate, soil colored layer of the cake. On top of that is the love economy, which is going to be things like volunteering and family, looking after each other, right? And all of these wonderful things that do not have a price tag attached to them. That, when I look after a family member, a child, or an elderly parent, I'm not getting paid for that. There is no economic transaction taking place. So, when it comes to the love economy and Mother Nature, these are not part of our economic calculations. They're non-monetized. They are fundamental to our economy, but they are not measured in our economy in any way. From there, we also have the underground economy, the quote unquote sort of black market. If you've ever bought something off of Craigslist or Kijiji, then, you've participated in this underground economy, which again is not counted as part of any of our, general ledgers. And then from there, even the part that we do count, so much of it is the public sector. That obviously our economy depends upon our education system, our healthcare system, so much of our public infrastructure. Business can't operate without those things. It is just so fundamental that really, that what we're talking about tonight is really just the icing on the cake. It's the private sector, not even the private sector. On top of that is like the stock market, like publicly traded companies. This is sort of, it gets so much of the attention in the media and the business section of the newspaper. And, really we spend so much time talking about the stock market. But I want to be clear, the stock market and the private sector could not exist without all of these other layers of the cake. So although obviously our focus tonight is going to be mostly on this private sector, on that sort of saccharine sweet icing that goes on the cake, really want to reinforce that there are all of these other wonderful things that we absolutely depend on, right, in order for this private sector to operate. So we are talking about an investment portfolio. So after that lovely cake chart, I do have your first pie chart of the night, that really, when it comes to a traditional portfolio, really what you're looking at is a mix of stocks and bonds. Okay. And that, I'm not sure the sort of the level of financial knowledge that's in the crowd right now. So I'm just going to give a quick little overview that, stocks, when we buy stocks, we are owning shares in a company and we share in that company's profits, right? So when the company does well and the stock price goes up, we benefit from that. If the company does poorly and the stock price goes down, the value of our stocks are going to fall. That really over the long term, stocks have been the best way to make money. However, there is risk, there's volatility. That's why I like to say that stocks are like the rabbit in the race, that they go up and then down and then up and then down. But over the long term, stocks have been very, very good to us, have been the best way to invest and make money. Bonds are more like the turtle in the race. Bonds are safe. Bonds are debt. So with bonds, we are loaning money to governments and corporations, right? So there's nothing sexy about bonds. We're not going to get rich off of them, but because we are loaning money to governments and corporations, we're earning that nice, consistent interest payment every single year. We're just getting paid that interest payment. And what's great is that stocks and bonds tend to be what we call inversely correlated. They tend to move in opposite directions. This year's been a little bit funny because stocks and bonds are both down, which is very rare. But typically stocks and bonds move in opposite directions, which is why any traditional investment portfolio, you're always going to have a mix of stocks and bonds. In this case, I've got a typical balanced portfolio, 60% stocks, 40% bonds. It's going to be different for everyone based on your age, based on your risk profile. This is something that's going to change, as you get older. You should have more bonds in your portfolio, but this is just really an example of a traditional investment portfolio would be a mix of both stocks and bonds. But the problem with a traditional portfolio, like when I started doing this, I remember I got an early inheritance from my grandfather. I was able to pay off my student loans and had a little bit of money to invest for the first time. And I looked at the traditional options that when I just, see what's out there, if you just kind of walk into your bank or credit union and say you want to invest, that when you open up those funds and see what's inside, that there were some nasty companies in there. And that, so Philip Morris, which is tobacco, Lockheed Martin, which is weapons, ExxonMobil, which is, obviously an oil company, that generally speaking, if we just invest by default, we just sort of walk into a place and get sold an investment product, there's a good chance there are going to be a lot of these nasty companies in here. Everyone has a different idea of sort of the things that are going to be a bit of a trigger for them, that are going to make them feel, kind of gross. You're going to have a visceral reaction to owning some of these companies, and that's totally normal. So, this is a real problem, or at least it was certainly for me. At the same time, as I was doing a little bit more research and specifically looking at it from a carbon footprint perspective, I started to realize what kind of an impact our investment portfolio can have on our own personal carbon footprint, right? That really, this was a study that was done in 2018 by CoPower, and it looked at the personal footprint of a portfolio. And you can see, certainly I want to be flying less and, traveling a little more locally, that I don't want to drive a gas car if I can have an electric car, or better yet, use public transit or, my bicycle. And certainly we all ought to be eating less meat. Absolutely. We should all be taking those actions in our lives. However, if you're taking all of these actions and you've just got 100K invested in the stock market, right? The combined annual carbon footprint of that 100K portfolio is likely larger than all of those actions combined. If you've got, a 500K portfolio, oh my goodness, Obviously having a child, I still want people to have kids. I don't like it when this is a deterrent, but this is one of the biggest actions that if you took all of the sort of, the lifetime emissions of having a child and, of having another being on this planet and doing that, even then, if you've got $1 million portfolio, it's quite a bit higher than that. So to me, this is a really stark example of why, if you just ignore your investment portfolio, if you just go with that default traditional option, if you're not really intentional about these things, that, unbeknownst to you, you've got an investment portfolio with a massive carbon footprint. And people are usually quite shocked when I show this chart. Right. And again, it's not a silver bullet. This isn't the only action. I still want you to take all of these other actions. But if you've got a portfolio, if you're in a privileged enough situation such that you've got an investment portfolio, you really need to be thinking about the carbon footprint and the decisions that you're making here. So the good news is that we can have a responsible or a sustainable portfolio. That it doesn't have to be that way. There are options. And so this is really what I'm going to be showing you tonight is that, when it comes to a sustainable portfolio, we are still going to have a mix of stocks and bonds, but we're going to break it up between, what I call doing less evil, which is how do we invest in stocks and bonds, but get rid of the nasty stuff. And then, we can carve out part of our portfolio for green stocks. You don't want to put all of your money into green stocks, but we can carve out part of it. We can also carve out part of your portfolio for these impact bonds, these impact investments, which is the piece of the pie that I am most passionate about. And I'm really excited. I'm going to show you a couple sort of examples of what that means. But really, this is my approach to investing. Is that we're still going to be mostly, stocks and bonds and kind of doing less evil. We're going to get rid of the worst companies. But then what we can also do is, very intentionally and deliberately put in some green stocks and put in some impact bonds. So what I'm going to do tonight is really kind of go through these different sections of the pie and kind of briefly explain to you each one. Certainly, if there's any section that you have more questions about, put it, we've got time for Q&A after. I can't wait to be able to answer your questions, but I'm going to do my best to at least give you a high level idea when it comes to each of these concepts. Before I do that, just want to say that, this is obviously something that I'm quite passionate about, because what I found is that, most people just haven't ever thought about their investments. That the sad reality is that people have spent more time choosing avocados in a grocery store than they've spent choosing investments for their retirement portfolio. And hey, don't get me wrong, I know how important it is to find a good avocado in the grocery store. It's very important. But again, when it comes to your investments, this is just such a critical decision that you're making, that I really want people to bring the same level of intention, just like we make decisions about where we spend our money and, where we donate our money. I want you to have that same intention about where you invest your money. The last point I need to make before I jump into sort of the explainers of those different approaches is that individual actions matter. I'm getting a lot of people coming to me saying, Tim, it's more about the government, or it's, it's these large corporations, it's really individual actions don't really matter. It's these systemic issues that we need to address. And I just think that is complete bunk. Don't get me wrong, though, we are part of these systems, and yes, those things matter. But to me, really individual actions matter so very much. That especially when it comes to the economy, especially when it comes to the market, that really, these systems are made up of millions and millions of individual choices. So absolutely your individual actions matter. They matter for you and for your family, but they also matter for society and for the environment. That to me, it is so important that we align our personal choices, and especially when it comes to our money, with the change that we are trying to create on a systems-wide level. So, just really want to reinforce this, that absolutely this has an impact. I'm happy to get into change theory stuff. I'll talk a little bit about it later. I can go into more, how does it actually matter? But to me, like, yes, it is undeniable that these actions matter. So, when it comes to the doing less evil approach, again, this is going to be probably the biggest slice of your pie, that these approaches do apply to both stocks and to bonds, that there are three main strategies that we use when it comes to sort of doing less evil. The first strategy is called negative screening. This is also called divestment. This is where we exclude quote unquote sin stocks. So, I think in Nith Valley, I think a lot of you are probably in the heart of Mennonite country. Correct me if I'm wrong there. And that that really the foundations of this do come from religious backgrounds. That when it comes to this notion of quote unquote sin stocks, that's why a lot of the typical exclusions that we see are alcohol and pornography and gambling. And then more recently, certainly military companies have been a big part of that. And, it's really only been in the last decade or so that a lot of people do want to divest from fossil fuels. So when we have a negative screen, that means not one penny is going into those specific sectors. So if that's a hard line in the sand for you, where you're like, Tim, not one penny, then the language you need to know is that I want to have a negative screen to make sure that none of those companies are going to be included in my portfolio. But there are other approaches, like we don't just have to right away go towards, cutting it out. The next approach is this acronym ESG, which stands for Environmental, Social, and Governance Analysis. So this was what my thesis was based on about 14 years ago when I was studying in Sweden. I looked at ESG issues. And this is the idea that in addition to doing the financial analysis, to looking at a company's revenues and expenses and their profit margin and all of that typical financial analysis that we're doing, we're also looking at environmental issues, social issues, and governance issues. So when it comes to environmental issues, right now, the biggest one certainly is CO2 emissions, that, there's a big risk that we have carbon pricing now, and that, companies need to be concerned and measuring and have a strategy in place on when it comes to CO2 emissions. But it also looks at water use. It looks at pollution. It looks at, all different forms of waste, really any impact that they're having on the environment should be captured by, this ESG analysis. When it comes to social issues, this is a lot more about labor issues. So this is about how well you're treating your employees, right? And we're seeing right now, like, the labor market is tight. Like, it's hard to get workers. The companies that are treating their employees well, right, where companies are more productive, are doing really well. They're not having those same problems. So, this social issue is absolutely critical right now, when it comes to how well a company is doing and, how profitable they're going to be in the future. And then the last piece is governance, which is, governance is so important. It's absolutely fundamental to how a company operates. This is looking at the board of directors. So it's looking at things like diversity on the board of directors. Is there a mix of both men and women? Looking at racial diversity, looking at diversity of backgrounds so that the board isn't homogenous, they don't have groupthink. It also looks at things like executive compensation. How much are we paying the CEO? How much are we paying board members, right? And is that actually aligned with some of these ESG issues? So when it comes to ESG, there are, hundreds of indicators across environmental, social, and governance issues that we look at all of those, and that generally speaking, we end up with sort of an ESG risk score, or that's often what I call a sustainability score. And what we can do is use that information to make investment decisions. Some groups are going to do a negative screen when it comes to ESG, saying, hey, if your ESG score is below a certain threshold, you're cut. I don't want to invest in you. Other investors are going to do what we call an ESG tilt, where they might just put more money into companies with a higher ESG score and less money into companies with a low ESG score. There are different ways of doing it, but really with ESG, what I'm getting at here is that we're not just looking at the financial piece. we're also looking at these other issues that are obviously very important to a company's long-term profitability. The last approach we have when it comes to doing less evil is shareholder activism. So when we own shares in a company, when we own stock in a company, we're shareholders. We are owners of that company. And we get to vote at that company's annual general meeting, their AGM. Right? So every year the company has an AGM. And what we're seeing now is that investors who care about sustainability are engaging with these companies and trying to push them in a more sustainable direction. And so, we might be asking for better disclosure around CO2 emissions. We might be asking them to publish an annual sustainability report. If we don't have this information, that's a huge risk. We want that information. There are all kinds of different shareholder actions that investors take. And what we want to do is make sure that, I'm not expecting anyone here to show up at a company's AGM and actually vote for their shares. No. Instead, what we do is we want to invest in funds. We want to make sure that whoever we're trusting to, manage the money on our behalf, that they have a mandate to be able to vote our shares in a direction that pushes forward on these sustainability issues. So it is very much, even though it's like activism, it's a pretty passive form of activism. You don't actually have to show up at the meetings at all. You just have to make sure that wherever your money is invested, that, they have instructions saying, I want to make sure that my shares are voting for these types of motions. So, these are all approaches that we can use when it comes to sort of doing less evil. Really when it comes to performance, I always get this question, well, Tim, I need to save money for retirement. I want to make sure that I'm doing well. And that, oftentimes there is an assumption that with sustainable investing or ethical investing, you're sacrificing financial performance. But I want to make it clear that when it comes to this doing less evil, that is not the case. The goal is we're trying to earn the same returns as you would normally. So I just took a quick little chart here. And again, in the Q&A, if you have questions, I'm happy to show you this in real time, but I took a screenshot from today and I just charted the blue line, which is XEQT, which is a very standard non-sustainable global equity fund. This is what we often refer to as a couch potato style fund, where this is the entire global stock market, meaning that a lot of those companies I mentioned, the nasty companies, are going to be inside of XEQT. And that's the blue line. And this is the performance over the last 2 years. 2021, it was pretty good. And then on this year, it hasn't been so good, although, it's come back up in the last month or two. And the green line is GEQT, which is another fund very similar to XEQT, except it is fossil fuel free and it has no tobacco, no weapons, no gambling, all of those negative screens, including fossil fuels. It is fossil fuel free. At the same time, it does ESG, that it gets rid of companies below a certain ESG score, and it does have shareholder engagement. Right? So this is a fund that ticks all three of those boxes on the previous slide. And you can see that the performance over the last 2 years has been almost identical. And look at how closely it tracks the benchmark. Now in 2021, sustainable funds actually outperformed. They did better than the standard investment funds. But in 2022, they have underperformed. That if I showed you just the year, right, it would have done worse. That obviously oil prices have gone up a lot this year. Fossil fuel companies have, done very well this year, right? But even with that, in a scenario where it's this perfect storm of the war in Russia and quote unquote energy crises happening where, the price of energy has skyrocketed. This is a perfect year for, for energy investors. It's really not that big of a deal. I think it's down. It underperformed this year, maybe by a couple of percentages. And really, if I look at the 2-year chart, the returns have been almost identical. So really, when it comes to this doing less evil approach, I want to be clear that we're not sacrificing financial returns, that the goal here is to earn roughly the same returns as a traditional fund. We're just getting rid of the worst of the worst. Now, there are some trade-offs. It's not, a perfect thing. This isn't, a fantastic solution for everyone. There are trade-offs when it comes to these doing less evil approaches. The first one is higher fees. Now, this is going to depend, and it's not always, but most of the time, the socially responsible or the sustainable version of the fund is going to have a higher fee. Part of that is because they're doing the additional analysis, they're doing the shareholder engagement, it's a little bit more involved. But a bigger part of it is just that, the fund companies feel that they can get away with charging a premium for this. It's kind of like how the grocery store, charges more for the organic apples, like consumers kind of expect that. So, when you're making this choice, you do want to look at it to make sure that the fees aren't substantially higher than what you were paying before, but that is a clear trade-off here. As well, there is less diversification. That obviously the more things we cut out of the portfolio, the more of those negative screens that we have, the less diversified we're going to be, right? So again, there are a bunch of choices. Some of them are, just a small step in the right direction, are going to have almost the same diversification. Others are going to be, have more intense screens, right? Those ones are going to be less diversified. The more things you cut out of your portfolio, the less diversified you're going to be. That said, there are some benefits, right? And the benefits of doing this is, number one, lower ESG risk. That, if we're moving, if the economy is moving towards sustainability, it makes sense that the companies that are ahead of the curve on issues like climate change, on issues like employee safety and satisfaction, on strong governance, right? That those are actually less risky if these sustainability risks continue to emerge in our economy, right? So, there is a benefit there. And there's also this benefit of values alignment. Like, I want to be clear that this is a really important thing, that when your investments are aligned with your values, like, that feels awesome. Like, it feels really good. And it's more than just the warm fuzzies. What I find is there's also a loyalty that when it comes to investing, we really don't want people like tinkering with it too much or trying to time the markets. The biggest mistake investors make is that when the stock price goes down, when the stock market crashes, if they panic and sell their shares, that's like the worst thing you can do. And what I find is that when our values are aligned with our investments, that we're much more likely to ride out the storm, to hang in there, and to actually, stick to our investment plan when we do have that values alignment. So, it's not perfect. There are some trade-offs, right? There are some benefits. There are some drawbacks. I want to be very, very clear and upfront with those. But that ultimately, I think the biggest reason to do sustainable investing is really if you sort of buy into this business case for sustainability. This is a book by a guy named Bob Willard. He's from Whitby, Ontario. Again, sort of a mentor of mine. He was an advisor on my thesis way back when, but he's done a lot of work on the business case for sustainability. And in his book, The New Sustainability Advantage, really he just talks about how companies that are leaders in sustainability are more efficient, right? Because they use less energy and less water and less materials to make the same thing. They're more productive because their employees actually care. They're more loyal and more satisfied. So they work harder and, are more likely to stick around. Whereas, companies in, that are laggards in sustainability, they often have to pay a higher salary in order to attract and retain employees. And the last piece is that they're more innovative. That, if we are moving into a world that, where consumers care more about ethical sourcing, about the environmental impact of their products, right? That these are the companies that are going to be innovating that next generation of products and services in a more sustainable economy. So, really this is my thesis, is that there is a business case for sustainability, that our economy is moving in this direction. Therefore, to me, it makes sense to invest in a way in that identifies companies that are leaders in this transition. Now, there is a big issue right now around greenwashing, right? That, you probably, many of you have read articles about ESG or about sustainable investing and, really not sure what to make of it. That is it all just greenwashing? The reality is that there is a lot of greenwashing when it comes to this, that it's a little bit of a wild west right now, that ESG especially is a very popular label. There's a lot of buzz around ESG. And so, you kind of have to be a little bit careful with it. That, the good news is that there is such a wide range of options. Like there are so many choices available. Some of them are more on the greenwashing side, to be blunt. Some of them have the name, sustainable or ESG, like in the title. And when I look at what's actually inside, it's not very good. So, there are a wide range of options. Part of my job is to help people understand which ones are sort of more greenwashing versus which ones are more sort of legit sustainable. I'm happy to get into more information about how I do that and how I actually look at what's inside. But really, this is my way of saying that it is a bit of a minefield right now, that again, you need to be very intentional making these decisions. Don't trust the brochure, the marketing, or like the label, the title of the fund. Really, I want you to look inside. Do they have negative screens? Are they doing ESG? Are they doing shareholder activism? Those are the types of questions you need to be asking to make sure that you don't get caught investing in a fund that is just greenwashing. Okay, so that's the doing less evil stuff. Now I'm going to get you into the green stocks a little bit. So with green stocks, we're investing in things like renewable energy, clean technology, water infrastructure. These are themes, right, that are focused on these sort of green themes. The issue with these green stocks is that they are a lot more volatile. This is why, like, when it came to the pie chart, right, I only wanted you to carve out part of your money for green stocks. Is that the problem here is that there is a major trade-off, that these are not diversified at all, right? They're only green stocks, and they tend to be very volatile. This is, again, that XEQT, so our very sort of standard benchmark for the global stock market. And I have this chart going back a little bit further, and I have the green line is ICLN, which is a clean energy fund. So this is like the iShares Global Clean Energy Index Fund. And you can see that, oh my goodness, we've done very well with this if you bought it in, before 2020, because green stocks popped. But just like they popped, as quickly as they popped, I want to show you how much they dropped. That when it comes to these green stocks, you have to be very, very careful. I'm not saying don't do it. I'm just saying a big mistake that sustainable investors make is they want to go all in on green stocks. They're like, Tim, they're doing less evil stuff. I don't really like that. I want to do more good. I want to do, I want to put all my money into renewable energy. And that is a terrible financial decision, right? Because these things are so much more volatile, right? That I did. So this is going back all the way. So, I mean, investors have made money when it comes to these green stocks over the last few years. But when I look at just the last year, this is the chart, the 1 year chart for green energy stocks, right? And you can just see how far they dropped and then came back up and then dropped again and then came back up. And then remember when in the US they passed that bill, that Inflation Reduction Act, where, Joe Biden got his green energy plan and they popped again and then they came back down. That basically, roughly have done pretty similarly to the rest of the global stock market, but the roller coaster is way more intense when it comes to green stocks. And I've seen so many people go too heavy into green stocks, right? So there are some cool options that exist. We can carve out part of your portfolio for things like renewable energy or clean technologies or water infrastructure, or like their funds aligned to the UN Sustainable Development Goals. Like there's some really cool things out there. But a big part of my job is, wearing my financial planner hat is saying, okay, let's be intentional about this. How volatile are these? How risky are these? Let's be really intentional about carving out part of your portfolio for green stocks. I'm not saying don't do it. We can totally do it. And again, if we want to bet on the emergence of a green economy, it makes sense to put part of our money into these things. But I really like, strong word of caution here about trying to go all in when it comes to specific technologies or specific sort of themes is what we call them, that really diversification is so paramount that we need the doing less evil stuff, right? In order to, have that diversification and then carve out part of it for these green stocks. From there, really the piece that I'm most excited about is impact investing. So, and I'm going to be talking specifically about impact bonds. So again, bonds are debt. And so we are loaning money directly to nonprofits and co-ops in your community. So when it comes to impact investing, this is like my absolute favorite part of the pie, because this is where we can have a direct positive impact. That all the other stuff I've been talking about tonight happens over the stock market, right? That when it comes to the stock market, that is what we call a secondary market, that we are buying and selling these shares from other investors. Whereas when it comes to these impact investments, we are loaning money directly to organizations that we want to support. And I just want to be able to, show you a couple of examples here. I tried to get things sort of as local as I could. And so that, there is right now, currently at this moment in time, there's an impact bond available from Habitat for Humanity in the Guelph Wellington region. I assume most of you have heard of Habitat for Humanity before, where, it's about building affordable homes. But in order to build those homes, they need to buy the land first. So how the heck does a nonprofit buy land? Well, they need money for that. And so they've issued impact bonds where we can loan money to Habitat for Humanity for them to be able to buy the land and build those homes. And this is a way I just kind of took this screenshot from them. I'm happy to go into more detail if people are curious about this specific one. I'm happy to dive deeper in the Q&A, but this is a way, put your money to work, that you're investing in your community, that you can earn a return, right? So you do earn a financial return. You're building homes and you're building community. Listen, we all know that affordable housing is such a really important issue right now, that there's a huge problem, if not like a full-blown crisis when it comes to affordable housing. Habitat for Humanity is a great way to be able to get more affordable housing. This is a way that we can support Habitat for Humanity while still earning a financial return. Another cool example here is 10 Carden. So this is a co-working space in Guelph, right? So I don't know if anyone's been to 10 Carden before, but this is a really cool space for, it's a co-working space. So nonprofits and co-ops and, artists and activists can have office space in Guelph, and that they own that real estate. They bought the building. How the heck does a nonprofit buy a building in downtown Guelph? Well, they used the community bond model. You can see here, they have different series here. So again, you can look at the minimum investments anywhere from $1,000, to get this higher rate. It is a minimum of 50K. So that's probably not for everyone. That's probably going to be too big a slice of the pie. Certainly it would be for me in the amount of money that I've got. But you can earn a financial return, in this case, anywhere from 2.75% to 4.5%. Now, keep in mind that when it comes to these things, so there are some risks when it comes to impact investments. And I'm going to use this as a bit of an example to share those risks, okay? Risk number one is what we call liquidity risk, that these bonds are locked in. So you're locked in for 5 years, or 3 years, right? Depending on which bond you buy. So this isn't like the stock market where you can sell your shares and just, I'm done, and I take my money and I'm done, right? Instead, you are locked in for a period of time. So that liquidity risk is paramount. That's number one. Number two is that what we call duration risk, that you're earning this interest rate and you are locking in this interest rate for the duration of the bond. So it's kind of like a fixed interest rate. Like, when you have a mortgage, there are fixed rates and variable rates. The variable rates go up and down with changes in interest rates. These do not. So these stay the same no matter what. So, if you're earning 2.75% for the next 5 years, well, what if interest rates keep going up? The Bank of Canada announced today, interest rates are going up again by another 0.5%, right? Like this has been happening. That if you locked into one of these bonds a few years ago, well, 2.75% might have been attractive then, but it's probably not very attractive now, right? So again, that duration risk, very important to understand that this is, you're locked into that interest rate for a period of time. The last major risk when it comes to these impact investments is what's known as default risk. This is the risk that the government defaults. right? That they go bankrupt, that if 10 Carden, if their model doesn't work, hey, we've just been through a pandemic, if people don't want to go back to the office and they can't rent out their space, they could be in a situation where they do default on their loans, right? In that case, there's a process. In this case, this is backed by an asset, which is the building in Guelph, the actual building that they own. So they would be in a position where they would have to sell that building, and then bondholders would line up, and it's usually like the bank gets paid first, and then, we're going to be in line somewhere, and hopefully they're able to sell the building for enough money to pay us back what we loaned them. But sometimes there isn't enough money. And so bondholders take what we call a haircut, where you do lose part of your money for this, right? So I want to be clear that there is risk when it comes to these impact investments, but there's also huge impact. That this is like a really cool way for me to support, a nonprofit in Guelph. I live in Toronto, and so I'm a member at the Center for Social Innovation, CSI, here in town. I bought a community bond. They use the same model to buy there. They own 2 buildings here in Toronto. And to me, it's just like, it's amazing that I can like go to work and go into the building that I helped finance, that I own a bond, which is one of the reasons why that building exists. Like, I can't tell you how good that feels, but B, the impact that the Center for Social Innovation has had, certainly on my community, friends that I have who are in the social entrepreneurship space. Really, really cool stuff. There are a lot of other options, okay? I have a list on my website of current available options. So these are retail, so these are, for everyday people. So there are a bunch of different options. I kind of highlighted the 2 at the bottom here, right? Just because those are the ones that regionally are closest to where you are. That said, there's the Fair Finance Fund. Like, I almost included that one. We could look at that one together in the Q&A if you want. This is about a sustainable food bond. So helping build a sustainable food ecosystem here in Ontario. Super, super cool. There are a bunch of different options that are available. I've got them listed on my website. Again, you don't want to put all of your money into these things, right? Most of your money should be in these more traditional, more diversified, more liquid, doing less evil stocks and bonds, right? But then we can carve out part of your portfolio for green stocks. We can carve out part of your portfolio for impact investments, but do it in a way that is very intentional, very deliberate, in a way that you understand the trade-offs, and that you're making this decision knowing both the benefits and the drawbacks. So really, my change theory, that's kind of mostly it for the presentation. I'll just wrap up letting you know sort of, that I'm on a mission to help 1 million Canadians invest intentionally. This is what I do day in, day out. I wake up and I just help people figure this stuff out and actually make the move. So shifting your money from wherever it is into sustainable investments. Again, I'm not like a broker or a money manager. I never touch my clients' money. Instead, I'm more like a coach or a consultant. I help people figure this stuff out. I help them narrow down their options, and I empower people to choose the investments that are going to help them achieve their financial goals while also be in alignment with their personal values. And so really, I'll leave you with these final thoughts, which is, that when I started doing this, 12, 14 years ago, it was so hard. It was so challenging. There were not a lot of choices. And oh my goodness, it's come so far that it's never been easier. And there have never been more choices than there are right now. That the whole sustainable investment ecosystem has just grown so much. There's so much momentum, which is incredible. But with that growth, it does come some of the concerns around greenwashing and stuff like that. So you need to ask the tough questions, right? It's still a bit of a Wild West. You need to do your homework. It's kind of like back in the day when, before organic was certified, where any product could just call themselves organic, right? That really you need to be asking these questions. You need to be, digging a little bit deeper than I wish you had to. But really, the last thing is just to really empower you. Like, put your money where your values are. Like, it's totally possible. It's totally doable. You can totally do it. You're not necessarily sacrificing financial returns. Like you can do just as well as you did before. And, you know, in my mind, this is a way of investing the money in a way that is in alignment with your values and like hopefully investing in the world that you want to retire into. Or if you're investing for your kids' education, investing in the world that you want your kids to retire into, right? And really, you know, really want to empower you to actually take the steps. Don't just think about it. Don't just talk about it. Actually put your money where your values are. That's it for me. That's kind of the presentation. I think I'm okay on time. I feel like I was pretty good there. And, you know, this is my email, tim@goodinvesting. People can go on my website and I offer everyone a free consultation. So if you just want to chat with me, you know, a little bit further about this stuff, you know, just know you can go to goodinvesting.com, click that free consultation button, or just send me an email. Obviously, I'm a bit of a nerd when it comes to these topics. So, you know, really excited to hear your questions tonight, but also, you know, if you ever had some, you know, practical questions about your own personal finance, you might not want to discuss those in a public forum. Just know that I'm here for you and happy to help.
That's awesome. Thanks a lot, Tim. That's great. Okay, let's jump into the questions then. Give you a second to take a sip of
I'll
water
have
or
a little
something.
water after that.
Yeah, that was great. I especially loved your point about investing around specific goals, like investing for your kids' education, the world that you want to see them grow up in. That's a really interesting idea I've never heard before.
Yeah, I mean, it really is. That's one of the first things we do with clients, and you know, is why are you doing this? Like, what is the goal? And, you know, is it for retirement, financial freedom? You know, is it for your kids and the education? You know, people who are older, a lot of times if they've got more than enough, they're actually in a position where it's for their legacy. Like they're like, Tim, I've got more money than I'm ever going to be able to spend. This is really for my kids and my grandkids and setting my family up. Well, that's great. That's awesome. That's amazing. And what's the world you want them to grow up in?
Yeah, exactly. Okay, starting off here, question from Neil. He says, we have a limited experience looking for ESG scores, and he sees a lot of different scores depending on the organization that developed the scale. And so he's wondering what is the most reliable scale for ESG scoring.
Oh my goodness. Okay. So it's Neil, right? Is that right?
Neil, yeah.
Okay, Neil, this is, oh my goodness, this is a kettle of fish that you have, barrel full of monkeys that you've opened up. I'm happy to go there. I'm going to do my best to not go too deep on this, okay? Because this is something I could spend like literally like 2 hours as a session on. ESG scores, like there's a lot and it's been changing so much. You know, really here, let me just share my screen and I'll just show you the two sources that I use and just very quickly kind of how they work. So the first one is Sustainalytics. So, you know, Sustainalytics was actually started by Michael Jancy, who is originally from London, Ontario. And they recently got purchased by Morningstar. So there's been a lot like these ESG firms and doing this, and that really, you know, there's been a lot of consolidation in the space. So Sustainalytics is now owned by Morningstar. And, you know, if I just use Apple, Apple's like the biggest company in the world, I can use as an example. The way they do it is they call it an ESG risk rating. And I can compare Apple to other companies within their sector, which is technology hardware, to be able to see, you know, okay, what is their risk rating? They do have, you know, I can compare it to Hewlett Packard, HP Inc. These are actually two different companies, Dell, you know, Canon. Okay, cool. You know, really to me, this is, you know, Sustainalytics is to me, I would put them up as a number one. I want to be clear when it comes to these ESG scores that they don't look at the product that the company is selling. Okay, so you might have a company like Exxon, right? Might actually have, you know, not the worst. They are considered high risk. What's one? I think Philip Morris that I mentioned. You know, that again, they're like a tobacco company, right? I think it's CR. Yeah, tobacco industry. But you can see they're only medium risk. And you're like, hey, Tim, what the heck, tobacco, only medium risk? Again, it doesn't look at the fact that they're selling tobacco. That ESG won't look at the fact that they're selling oil. Instead, they're looking at the company's reporting and disclosure and policies and performance, right? To be able to compare it to other companies within that same sector. So, but Sustainalytics is number one. The other one I really like is MSCI ESG ratings. Let me just do ESG ratings. And, again, really, really cool. Here's this ESG ratings and climate search tool. So again, I can show you Apple here, Apple Inc. And, I can look at their commitments to reduce its carbon emissions, right? Which is kind of cool. What's Apple doing on CO2? I can look at their alignment to global climate goals, which is really cool. And, here's what you were talking about, their ESG rating. So the way MSCI does it is they give it like a letter rating. Triple A is the most sustainable, then double A, single A, triple B, which is where Apple is, kind of middle of the pack. Double B, single B, triple C would be the least sustainable. Again, in relation to industry peers, so I can really only compare a company to companies within the same industry. It doesn't work to compare Apple to, a food company or to an energy company or to something else. I can really only compare it to other technology companies, but you can see it's, it's middle of the road. What's cool is the history. It's kind of hovered between single A and triple B, right? And then what I really love about the MSCI is it tells me which areas Apple is a laggard, average, and leader. So they're a leader when it comes to clean tech, which is they do a lot of really cool stuff when it comes to like solar panels and like, Apple, they do battery development, stuff like that, and controversial sourcing. So this would be like conflict minerals, right? Big issue. Apple is like on top of that, right? You can imagine they need to be. However, they're just average when it comes to corporate governance, human capital development, which is their workforce talent, right? Very, very important stuff. Privacy and data security, and e-waste. They're just average. And they're actually laggard when it comes to corporate behavior. This is like fraud. And there's this thing where Apple, they have a company in Ireland and they run all of their European sales through this Irish subsidiary to lower their taxes, right? So a bit of a tax shelter kind of thing, tax dodging. So that's why they're laggard here. And then also supply chain labor standards. I think we've all heard the stories about people working in, Foxconn or other suppliers that Apple has, around the world. There are some issues there. So, really that's, I don't want to go deeper into ESG because it's such, it's so easy to get in the weeds, but it's a fascinating topic. But Neil, to answer your question, Sustainalytics and MSCI are the two go-to sources that I use when it comes to evaluating company ESG scores.
That's great. And next question from Dean. How do you purchase an impact bond? So maybe, we just walk through one of those examples that you gave us.
Great question. So, when it comes to these impact bonds, we can't buy them on the market. So you're not going to buy them through a broker or through an advisor or anything like that. Instead, we're going to buy them directly through the organization. So basically what you're going to want to do is, go to the organization's website. So the easiest thing is, on my website, I've got hyperlinks to sort of the page for each of them. So, it would be like that, that 10 Cardin page or that Habitats for Humanity page. From there, usually you're going to have to download sort of a legal document, right? They're going to want to send you an investor presentation so that you can read about the offering and understand it. Once you've read it, you can kind of give it a thumbs up, say, yep, I'm ready to invest. You're going to be dealing with them directly. So you're going to have to fill out some paperwork, sign a couple things. You're going to basically transfer them the money. They're also going to need your banking information because they're going to need your bank account number so that they can pay you the interest every single year. So you're going to have to basically like fill out some forms. You can either write them a check or send like an electronic fund transfer for the initial amount. And then from there, they're going to send you the interest payments every single year. They're going to send you a T5 form, right? Because you do pay taxes on the interest from these impact bonds. So you're going to get a tax slip from them. And then when the term is up, usually like a few months before the 3-year term or the 5-year term is up, you're going to get an email from them saying, hey, what do you want us to do? Like, do you want to reinvest? Or, do you want to pull your money out? At which point you can kind of make a decision there. But to be clear, these are always going to be outside of your other investments. They're not going to be held in the same accounts. Although a lot of them legally are RSP, TFSA eligible, in practice, it's just such a pain in the butt to hold them inside of those tax shelters that, I usually suggest clients just hold them outside of registered accounts, which means that you are paying taxes on them, and that really you are dealing directly with the organization, and that you're literally going to like write them a check or send them an EFT, and then they are going to like literally send you an interest payment. I think it's usually like twice a year, every 6 months, you're going to get that money showing up in your bank account. Yeah.
Okay. And is there any other similar, if somebody maybe wasn't comfortable kind of going through that process on their own, maybe some other method or product that they could look at?
I mean, not really, to be honest, on the same like grassroots side. That there are, I see the next question relates to these things, ETFs, exchange traded funds. So there are, for example, like green bond ETFs. I'll address that in a moment. But that, but none of those are going to have the same impact, bluntly. That, that I can show you what's inside a green bond fund, and it's like, okay, cool, it's good stuff, but it's not going to be nonprofits or co-ops. It's not going to be in your community. These impact bonds really are, I call them like the crunchy granola type of investments. If we want to invest in a regenerative economy, in that really sort of dark green sustainable economy, and there are a lot of cool things coming out. I've seen conservation groups looking at, trying to conserve land with impact bonds. So there's some really cool innovation happening in this space. But one of the downsides is that, it's never going to be as easy as clicking a button to invest. You're always going to have to fill out some paperwork and set up the accounts and kind of go through that process. That said, you only ever have to do it once. Like you only do it one time when it comes to setting up those bonds. Once you've done it that one time, it's really easy to add more money, or if you want to take out your money, it's very easy. Their customer service is great because these are like nonprofits. You're not dealing with like, the banks that'll keep you on hold for 3 hours. These are people who, really care about what they're doing and, are going to be there for you.
Awesome. Okay. And then, yeah, on to James's question about the ETFs.
Okay, so yes, so just because ETFs is a very specific acronym, so, really the way most people invest are through what are called mutual funds. And mutual funds, we tend to buy them through an advisor, whereas ETFs are exchange traded funds. These are still funds, but they trade directly on the stock market. And so, James, this is my passion, is socially responsible and sustainable ETFs. So I'll just share my screen again, because, I do have my free resources. So on my website, goodinvesting.com, free resources tab, and this is where I actually have my sustainable investment lists. We can look at all-in-one ETFs. We can look at global stock ETFs. We can look at bond ETFs. We can look at the doing more good. This is like my list of green ETFs. So if I just show you like global stock ETFs, I don't want to like overwhelm people, but there are a whole bunch of them. And the MER, this is code word for management expense ratio, which is code word for annual fees. So again, the fees, they do go up, that some of them are a little more expensive, but I also have the ESG risk score, right? I also have the carbon intensity and percentage fossil fuel reserves. So if you did want to find some that are sort of fossil fuel free or very low carbon, but again, there are some trade-offs here. So really, what I would suggest is that if you are interested in these, sustainable ETFs, really good idea to set up a book a free consultation with me. This is what I do sort of day in, day out. It's important to look at what's inside of them and to choose the ones that are right for you. That, there are a lot of trade-offs when it comes to these things. And, it's sort of my job to help you understand those trade-offs, to find the balance between the ones that are going to, help you achieve your financial goals while also are in alignment with your values.
Okay, and then another very similar product, obviously maybe that some people would be more familiar with, would be a mutual fund.
Yeah.
Could you just talk, not that this is a sustainability question, but just the differences between those two things?
Yeah. I mean, basically mutual funds and ETFs, exchange traded funds, they're basically the same thing. They're just in different wrappers and they're sold through different channels, right? So mutual funds are sold to you by an advisor, right? You have to speak to someone. They're an advisor. They're going to be, selling you this product. Oftentimes, mutual funds are also what we call actively managed, meaning that, it's usually a rich old white guy in a, tower on Bay Street, right? And that's the portfolio manager, and it's their job to decide what to buy, what to sell, when to buy, when to sell, that they're actively managing that for you. And then mutual funds are then sold through an advisor or through a dealer that gets paid an annual commission for selling you that product. With ETFs, ETFs tend to be what we call passive. So instead of active, instead of having that manager that makes the decision, they tend to follow what we call an indexing approach. When it comes to an index, this is more of like a methodology or like a process or even like an algorithm to decide what's in, what's out, right? And so as a result, and also ETFs are sold directly on the stock exchange. So if you are a do-it-yourself investor, right? And then you can then buy these things just like you would buy a normal stock. You can buy an ETF, an exchange traded fund. But at the end of the day, they're the same thing. It's a fund, it's a portfolio with, dozens, if not hundreds, sometimes thousands of companies inside. Mutual funds and ETFs are very, very similar, but, mutual funds do tend to be a lot more expensive. ETFs do tend to be a lot cheaper. So, there are some differences there, but fundamentally they are very similar, right? It's just that my preference, my bias is that, I like it when people make intentional decisions and do it themselves. So, if you are comfortable with do-it-yourself investing, that's, typically the people that I help are people who want to buy ETFs, exchange traded funds. Whereas, if you walk into your bank or your credit union, they're not going to tell you about ETFs. Instead, they're going to try to sell you mutual funds. That is sort of how they make their money, but that is also the most popular way. I get it. A lot of people, they can't be bothered doing it themselves, that they do want to just, they're happy paying the higher fees to let someone look after it for them. But, especially if that is the case, even more importance that you are understanding what is inside of that mutual fund or that ETF. Is that helpful?
Yeah, no, I think that's very helpful.
Amazing.
Okay, and then to Patrick's question, considering how much of the Canadian economy is made up of energy stocks, if you wanted to divest from fossil fuels, how can you ensure that you have a good balance of domestic versus international equity?
Yeah, I mean, great question, Patrick. So diversification is like a core value, right? Like I want to be clear when it comes to investing, like just the same way, if we want to build a resilient ecosystem, we need diversification. If we want to build a resilient investment portfolio, we need diversification. So diversification is absolutely a core value. What I can do is just kind of show you, let me share my screen again and just kind of show you. So, in terms of like the global stock market, there's an ETF, a fund that I look at called the ACWI, the All Country World Index. Really, this is sort of code word for the entire global stock market. You can see here why ACWI, access to the global stock market in a single fund. This is literally like the entire global stock market. That if I show you the companies that are inside of it, like it's, 1 to 10 of 2,369. So this is what we refer to as hyper diversification. This is a really nice sort of like proxy or comparison tool for the global stock market. What we can see is we can see the breakdown by sector, and you can see that energy is about 5.37% of the global stock market. So it's not nothing, but it's also not huge, right? So if we get rid of energy, obviously we are less diversified. We don't have exposure to energy. However, it wouldn't be nearly the same impact as if we got rid of all of tech or if we got rid of all financials, right? That, energy used to be a lot more prominent, and over the last, 10 years or so, 10, 15 years, it's a much smaller part of the overall stock market. When it comes to Canada, you're absolutely right. If I show you XIC, which is the S&P TSX capped composite index. So this is the Toronto Stock Exchange, i.e. Canadian stocks. You know that when it comes to this, energy does play a much heavier role. That you can see it's at about 17%, which is a lot higher. That obviously the Toronto stock market is kind of dominated by banks and energy companies. So, I want to be clear that, this is the job that I do with clients. This is why, you might want to hire a financial planner, is to make sure that if you are doing this stuff, that you've got the right mix, that you've got the right diversification of Canada versus US versus the rest of the world. It's very easy, when we're doing our pie chart, we can decide how much for Canada, how much for US, how much for the rest of the world. And then obviously, if you don't want energy, if you don't want fossil fuels at all, and I want to be clear that when we talk about energy, this is not renewable. This is only oil and gas and pipelines. That with this classification system, solar panels are considered tech, wind turbines are considered industrials, and utilities, the wind farms and the solar farms are considered utilities. So really, when we're talking about energy, this is fossil fuels. And that I think it is important, to be able to understand what that trade-off is in terms of diversification. And then what I do as a financial planner, every day is I work with clients and I look at their portfolio to make sure that they are properly diversified across geography, and then also across sector, so that if you're going to get rid of energy, make sure that we are as diversified as we can be given your ethical constraints. And then I also look at diversification in terms of what we call asset classes, which is stocks versus bonds, and making sure that, your risk profile is, that your portfolio aligns with your risk profile. So, it is a little bit trickier when it comes to investing in just Canada, but really Canada should only be part of your pie. We do want to have international, we do want to have US, and there are funds for all of those. Again, I don't want to overwhelm people with the choices, but when I, on my free resources, I do have my very nerdy Google sheet. This is for the nerds in the audience. And I can show you, there are these ETFs, these exchange traded funds that are just Canadian stocks. Some of them are fossil fuel, some of them are not. We have just US stocks. We have developed equity, which is developed countries outside of North America. And we have emerging equity, which are emerging markets. That it's really easy to sort of build a pie chart that is globally diversified. But, this is where, really, I think there is value in having an advisor or having a planner that can really help you, through those decisions, understanding the options and making sure that you do have the right mix of funds inside of your portfolio.
That's great. And actually, I'm not sure if we've exactly defined the term diversification. I'm sure most people are familiar with the term just in other areas of their lives as well.
Right.
But yeah, if you just don't mind kind of defining that and explaining why is it so important when it comes to investing?
Yeah, I mean, really what it comes down to is that the goal, again, what we're trying to do as investors, what we should do is try to track the overall stock market. That a lot of people, when they think of investing, they think of stock picking, right? But that's a really bad way of doing it. Because in that case, I joke, you're throwing darts blindfolded, right? That none of us know what's going to happen in the future. That, really, I want to avoid people trying to time the market or to try to pick individual companies, because we just don't know. And that's where, you can get a lot of risk. So the way that we, reduce the risk in our portfolio is by having lots of diversification. And so broadly speaking, when we talk about your pie chart, broadly, the biggest way we do it is between, stocks versus bonds. And then for some people, they view real estate as part of that. So if you own a home or if you own a rental property, that might be another sort of asset class in addition to stocks and bonds that you can have, right? But that you never want to be all in stocks or all in real estate or all in cash for that matter. You do want to have this nice diversification. And then inside of each of those, the more diversification you have, the happier we are. Because really, when it comes to risk, there are these company specific risks, right? That, if I think about a company like Apple, there are a number of things that can happen to Apple's reputation, right? That could hurt them. And that, if Tim Cook there's like a CEO sex scandal or something, right? And all of a sudden, oh no, and it's like, it doesn't matter how much research you did, how much, analysis you did, something completely out of your control, and all of a sudden the share price falls, right? And so the way we kind of like, temper that risk, we still want to have Apple, right? It's still a good company. I want to own some Apple, but I'm going to be really intentional that it's only going to be a small slice of my overall pie, right? And so the easiest way to do this is through funds, that instead of buying individual companies, we buy mutual funds or we buy exchange traded funds, because that just makes our life so much easier. And then, this way you don't have to pay attention every day. You're not like opening up, the news and, oh, what's Apple doing? Should I buy? It just takes all that decision out of it. What I really advocate for is what I call couch potato style investing, which is simple, which is diversified, which is low fee. And this way you don't have to pay attention to it every day. We can be like couch potatoes and we just come up with a plan. And if the markets go up, we stick to the plan. If the markets go down, we stick to the plan, and we just don't stress out about it. And that really, that history has shown that, over the last, decades, that really has been the best approach. Is just to come up with a plan and stick to the plan. So, diversification, we look at it through a number of different lenses, but it comes back to the old adage, you don't want to put all of your eggs in one basket, right? We know that. So, what are the different types of baskets that we can have? And that, and then even within those baskets, we'll have even like other baskets, to be able to spread out our eggs as much as we possibly can, but given our ethical constraints, right? Like, to me, I'm someone where I'm willing to be a little bit less diversified if it means I don't own tobacco or I don't own military. And those are just tiny little baskets that I'm giving up, like just a fraction of a fraction. Those are tiny. When it comes to fossil fuels, per the question that was asked, that's a slightly bigger basket. Right? So when I'm deciding not to put any eggs in that fossil fuel basket, that's a choice that I'm making. It means that, for example, this year when oil prices went up and oil companies did very well, I didn't get that benefit, right? Now, did it really impact me? No, I showed you the chart. And because it's only a small slice, it didn't really impact the returns that much, but it did a little bit, right? And so it's really important to understand that there are trade-offs, that when we're less diversified, right, that there is a trade-off there, that, oil stocks did well and I didn't capture any of that. That said, in 2020, oil stocks crashed. I also didn't get any of that. I didn't have any eggs in that basket. So again, it's really up to you, but it is a choice that we're making. And I think it's important to understand the, both the impact, but also the consequences of that choice.
Yeah, exactly. It works in both ways.
Always.
Tom asked, how would I know how risky an impact investment is? So you touched on those different types of risk of an impact investment, but yeah, if somebody was trying to go out and buy an impact investment for the first time, how would they kind of assess that?
That's a great question. And again, the legal disclaimer, like, speak to an investment professional, that obviously, like, we're trained to evaluate these things and can really give you more, insight than I ever could just in a little Q&A here. Because at the end of the day, it depends. It depends on you and which risks of the risks that I outlined are most relevant to you, but it also depends on the impact investment. That every single thing on my list has a different risk profile. Each one is very unique. The first two things are pretty straightforward, like the liquidity risk and the duration risk. It really depends how long you're locked in for, right? So it's going to be different if you're locked in for 1 year versus if you're locked in for 10 years, right? That one is very straightforward, that obviously the longer you're locked in, the less liquidity you have because you can't sell it for longer. As well, the more duration risk you have, because the greater likelihood that interest rates are going to fluctuate over a longer period of time, right? So those are very simple to evaluate. The one that is the hardest to evaluate is that last one, which is the default risk. Okay. And this is where, they will send you, it's called a prospectus document or an offering memorandum, are these sort of legal documents that you're supposed to read through. And each one of them is going to have a section on default risk. And you need to really make sure that you read that section. Really what it comes down to is two things. Number one is the overall financial health of the organization. Okay, so if I'm evaluating, let's say Habitat for Humanity as an example, I'm going to want to open up their annual report. I'm going to want to look at their revenues and their expenses. I want to understand where those revenues are coming from. And am I confident that those revenues are strong and will continue into the future? Right. And I want to make sure that they have money in the bank, right? That they're not, down to their last penny. They haven't been running a deficit for several years and, eating away at their money, and they might run out of money. I want to see a company that's in strong financial health. At the same time, the second factor that I'm looking at for default risk is that when it comes to the investment that I'm making, I want to look at, is it backed by an asset? Okay, so this is this financial term, asset-backed securities and asset-backed loans, which means that, they're borrowing money, but there is an asset tied to that loan. That if a company or a nonprofit is raising money and there is no asset, and I've seen this before, where they're actually raising money for operations, that's risky, right? Because if they do end up failing and defaulting, there's no asset for them to sell. You're going to lose all your money. Whereas if it's backed by an asset, amazing, right? This is like, if I'm loaning, it's like a car loan. And if you miss your car loan payments, they're going to take back the car, right? It's backed by the asset. There is a physical asset that, worst case scenario, they can sell that asset and pay you back part of the money. And then really it comes down to what is the value of that asset, that is there versus the amount of loans that they have. So in the case of, 10 Carden Street, they own a building in Guelph. The worst case scenario is that if they go bankrupt, they have to sell that building. So the question is, how much is that building worth? What is the market, the real commercial real estate market in Guelph? What is that? And that, and then you look at the value of that asset compared to their loans, right? Because they would have a mortgage and they might have other like senior debt. And, there might be people ahead of you in line. And so, not only is it the strength of that asset, but the last question is, where in line as a bondholder, where in line am I in the case of a default, right? Because really, again, the bank's going to get paid first. That's the only way you can get a mortgage, is like they have first right, on that asset if things go south. And then from there, bondholders line up. So every product is going to be different. You need to evaluate the asset. You need to see where, in line you are. And then obviously, just like the overall management of the organization, that want to make sure that they are committed to this and are going to fight for it. And what I see, it's really, really cool that with so many nonprofits, like when it's a for-profit company, if things go south and it's like just like, oh, the property is like underwater and it's not profitable for them anymore, they will sell in a heartbeat. And you'll take your haircut and you'll lose your money. That for-profit, they're sharks, they mean business. When it comes to nonprofits, they will hang on. They will fight tooth and nail to stay in business, to make it work, to figure out a solution. So to me, it's like, it's actually pretty cool, that I feel that there is that sort of added, benefit when it is a mission-driven organization, that they're not just going to give it up as soon as it's no longer profitable. They want to stick around as best as they can. That said, there's always risk when it comes to things. So, it's really important that you do look at that risk before you invest.
Yeah, it's a really interesting point, though, about the intangible nature of just, their passion for what they're doing and the goal that they're trying to achieve.
That's right.
Especially just digging into that a little bit further, because I'm sure lots of people haven't, if they're not DIY investors already, they've never even looked at a normal bond, let alone an impact bond.
Right.
So sort of, I think in terms of the credit and the liquidity risk, those things I think you overviewed pretty well. But when it comes to default risk, how would you kind of say that an impact bond measures up in general against just a regular corporate bond? Would you
Terribly.
say terribly? Okay.
Terribly, because they're not rated by the same agencies. So for, if we compare it to a government bonds are the safest. They are the highest rated. So if we look, it's kind of like that, those MSCI, remember we looked at the ESG ratings and there was like AAA, AA, single A. And then, so when it comes to a bond, a traditional bond, government bonds are typically the highest rated, right? So government of Canada, this is how they fund our deficits, is they issue bonds. And the likelihood that the government of Canada goes bankrupt is very low. It's not zero, like it could happen, but the odds of it happening are very, very small, which means that it's got a AAA rating. From there, you kind of go down the ratings that you'll have, the provinces will be a little bit lower. The banks in Canada, generally are pretty safe, have very good ratings, but as you start to move down the ladder, right, you start to get into what we call junk bonds. And these are sometimes, they got sort of rebranded as high yield bonds, because if a bond is riskier, they have to pay a higher interest rate, right? Because they're riskier. Investors want to get paid for that risk. And so, a great example for me would be like Bombardier, right? Like that's a company that's had some trouble. I think we all know Bombardier. We all, wish them well and wanted them to succeed. They haven't been great, meaning that we've watched as Bombardier's credit rating has gone down, right? Which means that they are a riskier and riskier bond compared to those other options. Now, when it comes to these impact bonds, they don't have a rating. They're not big enough. It costs, I think I saw, one group looked at doing it and it was going to cost them more than $100,000 for a credit rating agency to come in and to do it. And that, it doesn't make Habitat for Humanity has better things to do with 100K, right? So it's not going to be rated, which means that we have to assume that they are very high risk, right? And again, this is why I don't want you to invest more than you're prepared to lose. This should only be a tiny slice of your overall portfolio. I don't want you to run out and put all your money in impact bonds because they are considered riskier. Now, normally, if we were invested in a riskier bond like Bombardier, we would expect a higher interest rate, right? But that's not the case when it comes to these impact bonds. That they are offering, if you look at what they're offering what, the Bank of, the Government of Canada would do, or a GIC, which is like zero risk, it's guaranteed, right? So really, when it comes to the financial return on these impact bonds, I want to be clear that you're not getting the best return for the risk that you're taking. And that really the return on investment, as far as I'm concerned, is the financial return. You are earning a financial return. You're not going to get rich with it, but you are earning a financial return plus the warm fuzzies. That there is a warm fuzzy the fact that I own my Center for Social Innovation bond, or I own a solar bond, Solar Shares, a nonprofit co-op, right, that offers an impact bond, that, that I feel good owning that. I am supporting these organizations that I love and that I care about. And so that satisfaction, so it's really the ROI is the financial return plus the warm fuzzies. That's what you have to compare to the risk. It's never going to line up on a risk-adjusted return basis if I'm only looking at the financial piece, right? These things aren't going to line up with traditional investments. But, for those of us who are in the fortunate position of having enough, if we're very fortunate of having more than enough, then it absolutely makes sense to carve out part of our portfolio for impact bonds.
Okay. All right, and then over to you mentioned GICs. What about
Yeah.
GICs? They're offered by banks and trust
Yep.
companies. How would someone rank these for sustainable investment? A lot of
Ooh.
trust companies are mostly house loans. Is this
Yep.
more sustainable and socially responsible than a bank GIC?
Ooh, okay. So this is a yeah, great question. Great question. Um, okay, so first of all, GICs, the acronym Guaranteed Investment Certificate. So these are guaranteed, okay? These are zero risk. The reason they're zero risk is because they are insured by something called the Canadian Deposit Insurance Corporation. So it's just like keeping your money in a bank account, right? Where our money is guaranteed that even if the bank goes out of business, the bank goes bankrupt, the government, there is insurance to step in and cover you even if the bank goes bankrupt. So GICs are zero risk, which is why we love them. So when it comes to this, you need to understand the process of what banks do with our deposits. So whether I'm putting money in my checking or savings account, or whether I'm buying a GIC, it's same, giving money to the bank, right? It's sitting as a deposit for them. Now, what most people think, they understand that they don't keep all the money in the bank. They don't keep it all in the vault. They're going to keep a certain percentage of it and then loan out the rest, right? Except that's not actually how it works. If I put $1,000 into my bank, right, they're actually going to keep that $1,000 in the vault, but they're going to use what's called a money multiplier or a reserve ratio, and they are going to create $19,000 worth of loans out of thin air. This is like when I was teaching economics at Sheridan College, like this is when students, I would do this piece on how money actually gets created and their jaws would drop. Everyone thinks it's the Bank of Canada that prints money. No, no, no. 95% of the money in circulation is debt. We are a debt-based economy. And so the way that it works is that if I put $1,000 in the bank, it's not like they keep $50 and loan out the other $950. Instead, they keep the full $1,000 in the vault. They then create $19,000 worth of debt out of thin air and loan it out. Now, when it comes to banks, think about, I'll use RBC. They're the biggest. RBC is going to create $19,000 worth of loans for every $1,000 deposit I make. Who are RBC's loan clients? Who do they loan money to? They loan money to very large companies, including pipelines, including oil companies, including mining, right? That's just who their clients are. So when I put $1,000 into my RBC bank account, whether it's in my checking account or whether it's a GIC, I am enabling RBC to create a multiple. It's usually about 19 times multiple in loans to their customers and clients. This is why credit unions are awesome. Because when you do it through a credit union, if I buy a GIC or if I keep my checking or savings at a credit union, the same thing happens. It's the same thing. They're still allowed to create those loans out of thin air. That's just like how it works in the banking system. But who are credit union clients? Who are the credit unions loaning money to? They're loaning money to homeowners for mortgages and to local small businesses and small business loans. So my $1,000 deposit or my $1,000 GIC, by doing it through a credit union, is going to stay within my community. It's going to create $19,000 worth of debt within my community, likely in a much more sustainable manner. Right? Now, you mentioned these home trusts. Obviously, those are going to go to mortgages. I would feel better about going to mortgages rather than to, extraction companies. But that said, people have different feelings about real estate. A lot of those, depends on the home trust. To me, if you're looking at the most ethical GICs, you really have to look at the credit union system. Really, credit unions are amazing. I've got like a blog post on 3 reasons credit unions are awesome and how to fire your bank and join a credit union. This really is one of the easiest ways for people to align their money with their values is by joining a credit union. Not all credit unions are equal. Obviously, if it's a credit union out in Alberta, where there are a lot of small businesses involved in the oil and gas sector, it's going to be a little bit different. There are here in Ontario some really good credit unions that one thing that I look for is a stamp called B Corporation. So I don't know if people are familiar with B Corps, but there are credit unions in Ontario that are B Corps. I know about Libro, which is London, but has started to expand. So you might have heard of Libro. I'm a member here in Toronto of DUCA, D-U-C-A, which is the Dutch credit union, which is a B Corp. There's a really cool one in Kitchener-Waterloo, which is a Kindred Credit Union, right? That I don't know if they're B Corp, but their ethics are very, very strong. I know they've got really good policies there. So to me, when it comes to GICs, yeah, like the ethical, the sustainable aspect is only as good as the institution that you are essentially like depositing that money with. And that any way you slice it, Kindred is a B Corp. Amazing. Yes. Thank you for that confirmation. I will add it to my list of organizations that I know are B Corps. So, really, to me, that is like the highest standard when it comes to this stuff. And so the fact that Kindred is a B Corp, tells me that, okay, they're going to be, certainly be a much more sort of like ethical or sustainable GIC compared to a bank.
Okay, that's good to know. And another question we had was whether you would recommend someone, if they wanted to move their portfolio to be more sustainable, would you recommend that somebody do that all at once, slowly over time? How would you approach that?
All at once. That really, when it comes to this stuff, it really is, these are relationships, and that, I want to be clear, a sustainable portfolio is not that much different from a traditional portfolio. So they're going to have the same risk profile, the same return profile. Obviously, there are some differences, and depending on how far you want to go when it comes to the green stuff and when it comes to the impact stuff, and, and the doing less evil, like there is a range of options. So of course it depends, but generally, the risk return profile is going to be roughly the same. Like I can totally mimic an existing portfolio, and if you are moving it over, to me, there is some emotional labor involved in terms of making these decisions and doing the paperwork and getting it all set up, such that I really would suggest doing it all at once. But this is where you are going to want, probably a little bit of help to make sure that you're doing it right, to make sure that the decisions you're making that the risk return is the same as what you currently own, right? So this is why I exist, is to, help people do this. And whether you're moving to another full service manager, like a lot of people, they're in mutual funds now, right? And that they want to stay in mutual funds, or they want an advisor. I help people. I can do what's called a manager search, where we can interview several different managers to like find someone that is a good fit for you, that they can handle everything for you. That said, my sort of bread and butter, what, most of the time is helping people learn how to do it in a DIY manner, where you do learn how to do it yourself and buy these exchange traded funds. It can be a little bit scary when you're doing it the first time. This is like why we, hold people's hand as they go through that process. But really what I find is that simply by doing a little bit of homework, doing a little bit of research, talking to us, we can usually lower fees, even if you stay with the full service manager. That usually we can find someone that is lower fees than what you're currently paying, while also making it more sustainable. So, if we can find that option for you, then, there's really no reason to leave things where they are. That typically, it's just easier, especially if we're talking about RRSPs and TFSAs and these tax shelters, and you really kind of want to move it all at once. That, you don't have to, you can do it bit by bit, but I can tell you it's a bit of a pain on both sides, for you and the new person, but also for the old person. Like especially if you've got a relationship there that isn't really working for you, where you do want to shift it, as soon as you start to talk to them and say, hey, I'm not really happy, I want sustainable investments, you haven't been able to help me with this, I'm thinking about moving it, sometimes that relationship can kind of turn a little bit sour, right? So that's why, to me, it's just really the goal is to get everything, to do all the planning and to get everything set up so that you know that you're shifting into something that's very similar to what you currently have, but is just hopefully a little bit cheaper and definitely more ethically aligned. And then once we've figured out what that looks like, that's when you can kind of do things in one fell swoop. And then at that point, it's done. You can sit back with your couch potato style approach, get back to living your life and doing all the wonderful things, but, sleep well at night, knowing that your investments are aligned with your values.
Yeah, so would you recommend then somebody, if they're with an advisor now, which most people are, and their advisor hasn't talked to them about sustainable investments, but the relationship is good. Would you recommend somebody kind of bring a plan to that advisor, or how should they go about kind of starting out that conversation?
So I think you got to start by opening it up. I'm actually about to record a podcast. It's not going to air until the new year, but I'm interviewing someone about how to talk to your advisor about sustainable investments, because it's a question I get all the time, and that it's tricky, and that, really what you want to do is you want to start by bringing it up, right? So at your next meeting, or like set up a meeting with them, because oftentimes you won't hear from them. They don't want to meet with you very often. So, set up a meeting with them, do it on your terms, let them know that, hey, I'm really interested in sustainable investing. Sometimes people use the words responsible investing or socially responsible investing. Same thing as sustainable investing. You can use those words interchangeably, right? But that you want to do that. From there, gauge their reaction. Now, if they're good at their job, right, they will say, I hear you. Okay, great. And I have options, because I tell you, every bank, every advisor now has options. If they say there are no options, they're lying to you. I promise you there are options at their disposal, right? I don't know how good those options are, but everyone has options now, okay? And so, if they're open to it, and they're like, okay, let me do some homework, let me show you some options, right? Then if they're open to having that conversation, opening that up, awesome. If you've got a good relationship, fantastic. Hopefully they're good at their job and they will, help you with this. That said, I can't tell you how many clients I've had who come to me because they talked to their advisor and their advisor laughed at them, their advisor mocked them, or their advisor just tried to talk them out of it. Say, no, it's a bad idea. You're risking your money. It's stupid. This is a terrible idea. If that's their reaction, they're telling you who they are. They are not going to be a good fit for your needs, right? And that's when it's time to sort of shop around. Yeah. And that's where I can help. That said, that's point blank that, in this day and age, there are so many options available, right? It should be part of their knowledge that, yes, this is a market. The industry is shifting. What's really cool is that now a lot of firms, when you first sign up, there's a know your client form, right, that they go through, and a lot of companies now have to ask. It's like a regulation that they need to ask, are you interested in responsible investing? So more and more, this is becoming normalized and mainstream, but there are a lot of advisors that are very reluctant or resistant to it. I can talk for a long time about why I think that is, but if your advisor is one of those people, it usually means that they don't know anything about it. And because they don't know anything about it, they're afraid of going there, right? And if they haven't taken the time to educate themselves, and if they're not showing you an openness and a willingness to educate themselves, then that's just not going to be a good fit for you. Then it's time to shop around. And again, people spend more time choosing an avocado, right? Like, it's so many people are just with the person they've been with for decades. And it's because their parents had that advisor, or their family had that advisor, or like, you know what I mean? And it's just a default setting. But if they are not going to, to help you on this, if they're willing to learn, if they're willing to work with you, and yeah, let's do it. Let's look at the options. Let's talk. They might be a little skeptical, and in that case, I think that you can at least work with that. But sadly, most of the time, people I know have brought this stuff up. They've really been shot down by their advisor. And that's when that it's time to start shopping around.
Yeah. And whenever people have moved to the DIY side, has that been something that you've seen many people struggle with? Like, I think that's probably a pretty intimidating thing for a lot of people, but going with a couch potato model, as you've talked about, doesn't sound necessarily very hard.
No, it's super easy. It's never been easier, but people think it's hard. It's scary. It's daunting. So a lot of the barriers that I help people through are psychological. Right. And the way you get over the fear and the uncertainty is very much about, through knowledge and experiential learning. Like, you can always start it with a small amount. If you're not ready to move everything over, dip your toe in the water. That's fine. Right. We can do that. But, honestly, most people that come to me, if they're like, oh, I just want to dip my toe in the water, I just want to try, we go through the educational process and they learn about it and they see what it's like. And then it just something clicks and they're like, oh, I get it now. Yeah, I want to move all my money over now. Why would I leave it over there? Like, this is sort of a better way of doing it, right?
Yeah.
So that definitely there are a lot of psychological barriers. I totally get that. I am your friendly neighborhood financial planner. This is what I do day in, day out. Really, it's there are options. It's never been easier, but I get that it does feel very intimidating. Right. But once you actually start to look at it and dig in a little bit more, really, it's important to understand they never taught us this stuff in high school. So a lot of the stuff I'm teaching people is really basic financial literacy that we've just never learned. And that once you learn it, a light bulb goes off, and all of a sudden it's like, I get it now. This is very simple and straightforward. Let's get to it. I see Yolanda asking, what kind of fees would you expect to make the transition? Really nothing. There are no things. The only thing is there is often what we call a transfer out fee. So, whatever, if you're with a bank right now, for every account, so you'll pay it for your RSP, your TFSA, and then, any other accounts that you have, there will be a transfer out fee of usually it's about $100 per account, maybe $150 per account if they're trying to rip you off. But whoever is getting your money, the receiving institution, they want your money. They are usually willing to pay those transfer out fees for you. Right? Because they really want your money. That's how they make money. So, when I work with clients, it really doesn't cost them anything to do the transfer itself. Really what it costs is my fees that, to walk you through the education and to hold your hand and to make sure you're doing it right. And this is why I'd say set up a free consultation. I work on a sliding scale. So people who have more money, I save them more money. These things are bigger so they can afford to pay me more money, right? But people who, who have less money, it's no worries. I make sure that my services are affordable. Really, my goal is to help absolutely everyone. So, really, it shouldn't cost you anything to move other than your time. And, whatever you pay me, or, if you're going with another full service advisor, it won't cost you a penny. They're going to earn their money every year. A percentage of your money, a percentage of your portfolio goes to them. Whereas me, I get paid a flat sort of hourly fee so that, we would come up with a little, arrangement so that you would know exactly how much you're going to pay for all of the education and the learning to be able to do this. So there's really no, it's not going to cost you any money to do it. There are some implications. It can get a little bit tricky. Sometimes there are taxes, right? Like if you're selling all of your investments and moving it over and buying new things, sometimes there can be taxes there. But, those are taxes you would have had to pay at some point. So you're just paying them sooner than you would have otherwise. So, but really there, it shouldn't cost you anything to switch. But it really does depend on where you're going to and whether they're willing to cover those transfer out fees, which are a couple $100. And also, are their fees higher or lower than what you're currently paying? That would only be the downside, that if for whatever reason you have a sweetheart deal and very few people do, But if for some reason, it was higher fees that you're paying over here, but like I said, that's why just like talk to me. Most of the options that I know, certainly if it's do it yourself, like your fees are going to be a fraction, like literally 90% off what you're paying now. But even if you want a full service manager, the fact that people just haven't shopped around for this stuff means that if you just and kind of let me shop around for you kind of thing, that usually we can, lower your fees such that it'll actually save you money every year by switching.
Yeah, and then another couple questions kind of linked to this idea is one that came in was, do you need to be rich to invest sustainably? And then if you don't feel like you have enough money to invest,
Right.
but you think this is a really important, good idea,
Yeah.
what are some things that you can do to help promote the concept or
Oh, hell yeah.
advance the idea?
I love those questions. So number one, no, you don't need to be rich. So really, start investing. Some of the, the approach that I use is the do it yourself using these sort of online brokers. It's about, I think, $1,000 minimum to open up the accounts on the platforms that I tend to use. There are others where it's even less than that. But really, you can start investing sustainably with as little as $1,000. You won't be doing the impact investments. Like if you're doing $1,000, it'll mostly be the doing less evil stuff and using the funds, that the impact investments. I wouldn't do that until you've got more, because again, they have a minimum. So if it's the $1,000 minimum and I only want it to be, 10% of your portfolio, you need about 10,000 to really get started with that. But, I've helped people get started with as little as $1,000, right? I do have an online course. So, for people who are just getting started and can't afford to pay me for like the one-on-one coaching, I've got an online course, happy to do like a promo code for anyone that's on this webinar, if that's something that you wanted to do. But really for people who are getting started, it's very simple and straightforward. And then, if not everyone is ready to invest, that, in my online course, like the first module is like, before you invest. And, really what you want to do is number one, make sure all your debts are paid off, especially if you have like high interest debts, like a credit card debt, or, some of the, like a car payment, something like that, that's a high interest rate. You don't want to invest. You're better off paying off your debt first. And then also you want to have an emergency fund. That, I never want people to invest every penny, every dollar that they have. No. I need you to have an emergency fund, usually about 3 months expenses to 6 months expenses should be in cash, fully available. That's your emergency fund in case life happens or when life happens. You're not stressed at all. Once your debts are paid off and you've got an emergency fund, that's when I want you to start investing. So if you're not there yet, right? If you still have some debts or you don't have your emergency fund where it wants to be, really two things to do. Number one is, join a credit union. Get out of the bank and join a credit union sooner rather than later. It's easy to do it before they kind of get you like tied up with things like credit cards and mortgages and lines of credit. And like, they want to sell you more products. So, join a credit union while things are still simple. Right? Number one. Number two is that there are some amazing nonprofits and organizations that are advocates for this type of work. So, it depends sort of where you want to put your focus. If you're worried about climate change, 350.org, I'm sure many of you know 350, they do some really cool work around climate change and specifically around fossil fuel divestment. Right? So if you're part of a university, well, guess what? Your university has an endowment. There are now campaigns to push your university's endowment to divest from fossil fuels, right? At the same time, there's a really cool organization called Shift Action. So Shift Action, I really love because again, even though you don't have your own personal investments, and that really what you want to do is we're all part of the Canadian pension plan, right? So these big pension plans, like if you've earned any dollar, you're part of CPP, Canadian Pension Plan. So Shift Action is all about encouraging people to push those pension plans towards sustainable investments. So, there are other organizations, those are probably the two at the top of my list, which is really, 350.org and Shift Action, as sort of great organizations that do really cool advocacy work. Even if you don't have $1 of your own money to invest, you can still volunteer your time and your energy and your voice to be able to do this. And then, the last thing I would say is just talk about it. That right now, obviously, I'm really comfortable talking about money. Not everybody is. It's a bit of a taboo talking about this stuff. But if you don't have money, there's a good chance you know somebody who does, whether it's family, whether it's friends, whether it's colleagues. And don't be heavy-handed about it and tell them you need to do this, but more just, oh, I learned about community bonds. Did you know that Habitat for Humanity has this really cool thing? Or I learned about, ESG and how, there's a really cool way where you can still earn good financial returns, but do it in a way that's, doing less evil. Did you know about this? Have you thought about this? That, I've spent so much of my career just simply planting the seeds of this. When I started 12, 14 years ago, nobody had ever heard of sustainable investing. Like this just didn't exist. So I spent the first, decade plus just simply teaching people about this. Obviously now it's come a long way that now people are often aware of these issues, but still people don't really talk about their money, think about their money. So just, be open about it, talk about it with family and friends. And, by all means, share my website or, listen to my podcast and, share it with people that you think might be interested. That really this is an ecosystem. When we talk about sustainable investing, it really is this ecosystem that is growing very rapidly. So there are so many ways for you to get involved, to be able to learn more, to be able to volunteer your time, to be able to talk to other people, educate yourself, educate others, and get involved.
Yeah, I think that
You're good.
I think that's a really good way to wrap things up, actually, just in terms of how people can go out and spread the word. So thank you so much, Tim, for sharing with us. As mentioned earlier, for everyone, watch out for our email. A link to the recording of the webinar will be sent out with that. Some resources for additional learning. We'll link to some of the things that Tim talked about tonight. And then those details that I mentioned about showing solidarity with Indigenous members of the community, and a link to that feedback survey. Also, on one final note from the Eco Boosters regarding Bill 23, please write and call your MPPs to state your concerns about Bill 23 and the plan to remove thousands of acres of land from the Greenbelt. The provincial government's plans will not address the need for affordable housing. It'll make developers richer and municipalities poorer, will compromise our democratic process, and they disregard the climate crisis. So if you want any more information about that, or want to find out more how to help, please contact us at our email, nvecoboosters@gmail.com. We'll send that out in the email as well. And again, yeah, thank you, Tim. Thank you to everyone that joined us. And yeah, everyone have a good night.
Thank you so much for having me, Gardner. Really appreciate this opportunity. Thank you so much to everyone for spending a couple hours with me. I really appreciate it.
Yeah, thanks, Tim. All right, good night, everyone.